Most people believe the path to wealth involves working more hours. We've been sold a narrative that says if you have a 9 to 5, you are barely surviving. But if you add 5 to 9, you are suddenly an entrepreneur. I need you to pause and look at the actual balance sheet of your life for a second. Because if you ignore the math I am about to show you, you might spend the next decade running fast, only to find out you are actually moving backward. The uncomfortable truth is that for 90% of the population, a side hustle isn't a stepping stone to financial freedom. It is a trap. It is a mechanism that keeps you tired, distracted, and tax inefficient, effectively capping your earning potential right when it should be exploding. We treat extra income as pure profit, but we rarely account for the hidden liabilities attached to that cash. Today, I am not just going to tell you to stop driving Uber or selling PDFs on Etsy. I am going to walk you through the profit and loss statement of the side hustle economy and show you why doing less might actually be the mathematical secret to having more. Before we start dissecting the numbers, I want to frame this properly. I am not against hard work. I am against inefficient work. I am against trading your most valuable asset, your focused mental energy, for pennies on the dollar. If you are serious about optimizing your finances, you need to treat your time like an investment portfolio. Right now, subscribing to this channel is probably the highest ROI action you can take in the next 5 seconds. It costs you $0, but it ensures you get peer-reviewed, data-backed financial strategies delivered to you weekly. It's a small click for you, but it helps me keep the lights on and the spreadsheets running. So, hit that button and let's get into the first major myth, the illusion of the hourly wage. Let's start with the most common entry point, the gig economy. Driving, delivering, task-rabbiting. The allure here is incredibly strong because the barrier to entry is effectively zero. You have a car, you have a phone, therefore you have a business. The apps reinforce this by showing you a very specific number, revenue. You finish a shift and the screen says you made $150. Your brain immediately categorizes that as profit. You mentally spend that $150 on groceries or investing or debt payoff. It feels like found money. This is the common belief phase. We believe we are monetizing our downtime. We think, I was just going to sit on the couch anyway, so I might as well drive and make money. It seems like a zero-loss scenario. But in finance, whenever something looks like a risk-free return, you are usually the one paying for the risk without realizing it. Now, let's run the P&L on that $150. I've crunched these numbers across multiple vehicle types and cities, and the results are sobering. First, you have immediate fuel costs, which might take that $150 down to $120. Then you have the silent killer, depreciation. Every mile you put on your car is equity leaving your net worth. The IRS estimates this cost at roughly 65 cents per mile for a reason. If you drove 100 miles to make that money, you just burned $65 in vehicle value and maintenance reserves. Suddenly, your $150 revenue is actually $55 in pre-tax profit. If you spent 5 hours doing it, you aren't making $30 an hour, you are making $11 an hour. And that is before self-employment taxes, which we will get to later. You are effectively borrowing equity from your car and treating it as income today. You are liquidating your assets to pay for your groceries. Why do we do this? Why do smart people fall for this bad math? It comes down to cash flow visibility versus balance sheet invisibility. The cash hitting your bank account is visible. It gives you a dopamine hit. The wear and tear on your transmission, the tires wearing down, and the eventual replacement cost of the vehicle are invisible. They are future problems. Human psychology is wired to prioritize immediate liquidity over long-term solvency. We feel productive because we are moving, but financially, we are just churning water. It is the financial equivalent of a sugar rush. High energy now, crash later. You feel richer on Friday because of the payout, but you are poorer in December when the repair bill hits. Here is the protocol if you are currently in this trap. You need to calculate your real hourly wage, RHW. Take your total revenue for the month. Subtract gas. Subtract insurance increases. Subtract 15% for maintenance reserves. Subtract depreciation. Then divide that number by the total hours you spent, not just driving, but waiting for orders and driving back home. If that number is below your primary job's hourly rate, you need to stop immediately. You are not hustling, you are donating your time to a tech company. The solution is to cease all side hustles that rely on depreciating assets. Sell the car if you have to, but stop bleeding equity. Now, you might be thinking, okay, Tom, but I don't drive Uber. I do freelance graphic design or copywriting, so I have no overhead. And you would be right about the overhead, but you are missing a much bigger cost. This is where most people stop their analysis and lose out on hundreds of thousands of dollars over their lifetime. The biggest cost of a side hustle isn't gas or tyres. It's the destruction of your primary career trajectory. While you are chasing an extra $500 a month, you are likely ignoring the single biggest asset on your balance sheet. Let's look at the career stagnation phenomenon. The common belief is that your day job is fixed. You have a salary, it is what it is, and the only way to move the needle is to add something on top. So you work 9 to 5, come home, and grind from 7 to 11 on a side project. You are exhausted. You are operating at 60% capacity at your main job because your brain is fried from the night before. You aren't getting fired, but you certainly aren't innovating. You are just maintaining. You view your job as a paycheck source to fund your hustle, rather than an investor views a startup as a growth vehicle. I've run the numbers on this, and the disparity is shocking. Let's say you make $80,000 a year. You work a side hustle that brings in $10,000 a year. Total income, $90,000. Not bad. But because you are distracted and tired, you miss out on the performance review that would have bumped you to senior manager. In many corporate structures, that promotion comes with a 20 to 30% raise. That is a $16,000 to $24,000 increase, recurring every single year, compounding with 401k matches and bonuses. By chasing the $10,000 one-off hustle money, you missed the $24,000 recurring raise. Over 10 years, assuming standard 3% growth on that new base, that missed promotion costs you over $300,000 in lifetime earnings. You are picking up pennies in front of a steamroller of lost wages. The psychological barrier here is control. A side hustle feels like something we control. We land the client, we ship the product. A promotion at work feels like it's in the hands of a boss or HR. It feels risky to bet on a promotion. So we hedge. We diversify our income streams because we read somewhere that millionaires have 7 streams of income. But we forget that most of those millionaires built one massive stream first, and the other 6 were just investment dividends. We confuse diversification with distraction. We prefer the instant gratification of a $50 invoice paid today over the delayed gratification of a $20,000 raise next year. The protocol here is what I call internal hustling. For the next 12 months, I want you to take all that 7 to 11 p.m. energy and reinvest it into your primary income source. If you are in sales, that means prospecting later. If you are in tech, it means getting that next certification. If you are in management, it means taking the lead on the project nobody else wants. Treat your job like a client that pays you $80,000 a year, with a potential upsell of $20,000. If you had a freelance client paying you that much, you would over-deliver obsessively. Do that for your job. Secure the raise. Once you have maxed out your primary income, then and only then do you look outside. Maybe you have the energy to do both. Maybe you are a machine who can crush the day job and the side hustle. Fair enough. But there is another partner in your business you are probably forgetting about, and he takes a much bigger cut from your side hustle than he does from your salary. If you think the 24% tax bracket is bad, wait until you see what happens when you add the self-employment penalty. This is the part of the video where the math gets really ugly, and where most hustlers are actually working for the government without realizing. Most people operate under the assumption that money is money. $1 from your employer is the same as $1 from Upwork. But the tax code treats these dollars very differently. When you are an employee, W-2, your employer pays half of your FICA taxes, Social Security and Medicare. That's 7.65% that you don't see leaving your check because the company covers it. When you start a side hustle, you become both the employee and the employer. Welcome to the world of the self-employment tax. Here is the breakdown. You earn an extra $10,000 on the side. First, you owe the full 15.3% for FICA taxes. That's $1,530 gone immediately. Then, that income is stacked on top of your day job salary, meaning it is taxed at your highest marginal rate. If you make a decent living, that's likely 22% or 24% federal, plus maybe 5% state. So, you are paying 15.3% plus 24% plus 5%. That is a total tax drag of roughly 44.3%. Your $10,000 hustle is actually $5,570 in your pocket. You are doing 100% of the work for 55% of the reward. Compare that to investing in a long-term stock portfolio, where capital gains might be taxed at 15% or even 0%. Working for money is the most tax-inefficient way to build wealth. The psychological trap here is gross revenue blindness. We walk around saying, I made 10K on the side this year. It boosts our ego. It makes us feel successful. We mentally spend the gross amount. But the IRS doesn't care about your ego. When tax season hits, side hustlers are often the ones shocked by a tax bill they didn't save for. This creates a cycle of scarcity where the side hustle money, which was supposed to get you ahead, is now being used just to pay the tax bill generated by the side hustle itself. The protocol for this is strict. If you are going to hustle, you must operate as a business, not a sole proprietor engaging in a hobby. You need to aggressively expense everything legally possible to lower that taxable income. Portion of your internet, home office, equipment. If you cannot legitimately expense enough to bring your effective tax rate down, you need to ask if the hustle is worth it. Alternatively, prioritize investments that offer tax advantages, like maxing out your 401k or Roth IRA, before you try to earn more taxable income. Tax avoidance, legal avoidance, is often more profitable than income generation. We have covered expenses, career opportunity cost, and taxes. But there is one final trap that is more philosophical, yet it dictates your entire financial ceiling. This is the difference between linear growth and exponential growth. Most side hustles are linear. You sell an hour, you get paid. If you stop working, the money stops. This is fine for survival, but it is terrible for wealth. If you want to actually get rich, you have to break the link between your time and your money. The vast majority of side hustles are just second jobs in disguise. Walking dogs, consulting, tutoring, driving. These are service-based. They require your physical presence, or your direct mental attention. The problem is, you have a hard cap. There are only 24 hours in a day. You physically cannot scale a service business beyond your own stamina without hiring people, which introduces management stress and lower margins. You are building a cage for yourself, and the more successful you get, the smaller the cage becomes. Let's look at the math of leverage. If you tutor for $50 an hour, your maximum earning potential, assuming you never sleep, is capped. But let's say you spend 100 hours creating a digital course on how to pass algebra and sell it for $50. Once that asset is built, the marginal cost of replication is zero. You can sell 1 copy or 10,000 copies. The effort is the same. In the service model, 100 clients equals 100 hours of work. In the product model, 100 clients equals 0 extra hours of work. The side hustles that keep you poor are the ones with high marginal costs of replication. The ones that make you wealthy have 0 marginal cost of replication. Why do we gravitate toward service hustles? Because they are safe. I can find someone to pay me for an hour of work today. Building a product, a media channel, or a software tool requires upfront work with no guarantee of payment. It requires delayed gratification, which, as we established, humans are terrible at. We are afraid to waste time building something that might not sell, so we choose the guaranteed mediocrity of trading time for money. We choose the sure thing that ensures we stay middle class forever. The final protocol is the leverage filter. Before you start any side hustle, run it through this filter. Can this make money while I am sleeping? If the answer is no, it is a temporary cash bridge, not a wealth vehicle. Use it only to pay off high-interest debt, then quit. Your goal should be to move toward code or media. Write the book, record the video, code the app. Build assets that work for you. If you don't know how to do that, your side hustle should be learning those skills, not delivering pizzas. Side hustles aren't inherently evil, but doing them without understanding the math of depreciation, taxes, opportunity cost, and leverage is a recipe for burnout, not wealth. Stop trying to outwork a bad strategy. Optimize your main career, minimize your tax drag, and only build things that scale. If you found value in this breakdown, do me a favor. I'm collecting data on what actually works for you guys. Leave a comment below with the side hustle you tried and quit, or the one that actually scaled. I read every single one to help build future videos. And if you want to see the math on how to actually invest that primary income once you get it, click this video right here. I'll see you there.